Market Day Report. Let's get ready for another trading week. All right, we have that WASDE report behind us now and can really start maybe focusing on fundamentals, technicals, maybe. Let's find out how we've been trading corn in the overnight session. As we start a new week, the December contract at 416, it's up 3 3/4 cents. And obviously, those threes that you see in the earlier contracts for the old crop, July and September, those are concerns. Soybeans, USDA projecting 10.10 as the season average price for beans on this new crop. And guess where we are? 10.10 and a half. That's up 3 1/4 cents, while the August and September contracts are moving in higher territory. Wheat market. Well, the September is most active, and it's up 4 pennies, 5.49 a bushel. Hard red is trading 6 1/4 higher at 5.30 and a half, and the cotton market is up 29 points at 67.71. Let's bring in Brian Hoops, President, Midwest Market Solutions. All right, Brian, weekend's behind us. Can we start trading?
Well, good morning. Yeah, kind of an interesting overnight session. The weekend was pretty much devoid of any real fresh news, but we gapped lower Sunday night in all the grains. That's the second consecutive Sunday night gap lower that we saw. But in the case of corn and soybeans, we made contract lows and have recovered. In fact, we're trading higher, as you mentioned, into the morning hours in here. Now, if we could build off of this, maybe we could have some sort of a key reversal after posting contract lows. That may catch some of the attention of the fund traders, and maybe they won't be selling every little rally any longer. We can see a recovery in these grain markets. So we have to get above 418 for corn, and I think 1017 for November soybeans to post those type of key reversals. And that would certainly be technically a positive. Now, fundamentally, it's a little bit different story. You still have a lot of rain in the forecast, as Jeff was mentioning. Next 6 to 10 days looks very ideal for corn pollination as far as moisture and temperatures go. There's a start of some pictures on Twitter starting to make its rounds of poor pollination in some fields around the country. So that's something I think that fundamentally we'll keep an eye on. Maybe a little too early to really say that that is a major issue, but if that would happen nationwide, it could become some sort of an issue. So a lot of things at play in here. Of course, President Trump over the weekend also announced 30% tariffs against Mexico and the European Union. Those two countries are really key to grain trade for the U.S. Since China's really backed away from buying any U.S. corn or soybeans, the European Union's surfaced as one of the best buyers of U.S. corn products that's out there. Mexico's number one buyer. EU is really number two. And we're just not selling much at all in the way of China, despite June being a record month of imports of soybeans for China. They bought from someone else, Brazil, Argentina, but not the United States.
Yeah, good points there. All right, Brian, hang on. We'll take a break, come back. We'll talk about this very, very hot cattle market. Market Day Report continues in a moment. Cash trade last week in the South, 228 to 230, mostly 230, and then in the North, 238 to 241, mostly 240, and the rest at 380. Look where we took live cattle futures on Friday, up 315 on the August at 222.37, the October 219.80, and actually notice that every one of those contracts, October, December, February, April, all start with $219 and some change. Well, 325s on the front 2 months for feeders, 325.77 on the August, up 450, 465 higher as the trade took September to 325.87. And both of those contracts, actually, you can throw in October as well, settled at their highs for the session. And the hog market on Friday was in the red. August, 104.85, down $1.37. Let's go back to Springfield, Missouri. Midwest Market Solutions, Brian Hoops. This market remains hot.
Red hot, Tony. Yeah, cash markets sharply higher last week. We thought they would be higher, but not to the extent that they were. Calls right now are steady to maybe a touch higher. I think we're going to struggle this week. We've had positive margins coming into the 4th of July holiday and following the 4th of July holiday, but last week the cutout values really struggled. Select was down $5.50. Choice was down several dollars as well. And so that has pushed those Packer margins from a positive of about $100 a week ago to in the red of about $43 this morning. So they've really shifted around. That will change that Packer mentality about how much cattle they want to buy, how far they want to push these cash markets. The cutout values turning lower could be an indication that demand is starting to soften. They're not able to sell the boxes at these higher price levels, demand softening. That's always a concern in here. So I think if this is the time of year, if you're a producer and you saw these big gains in the futures market last week, locking in some of these price levels is a really good strategy at this point in time. Put options is still the preferred way to do it, maybe a put call spread or something like that. But trying to get some sort of floor in because demand is expected to be a little bit softer here going into the next several months, and supplies may start to increase, is what we've heard from some people. I look ahead to this cattle on feed report a week from this Friday. It looks to be a little bit tighter to me, a little bit friendly report as well. So I don't know if the number is going to get a lot tighter, but the concern is consumer demand at these price levels will start to back away, especially as we go into the last month or so of the summer.
Yeah, I think you've hit on a great point there, Brian, especially as we've seen consumers kind of trading down from the higher end, more expensive cuts down to, let's say, ground beef. And now you're basically cutting off some supply from Brazil. So this could be an interesting scenario. How about we come back on Wednesday and pick up the conversation? Brian Hoops, Midwest Market Solutions. And again,